Morning, everyone. Thanks so much for your time this morning. Paul's got some really interesting things that he wants to share. Just some formalities for the webinar. If you do have any questions, please just pop them in the chat box throughout the webinar, and I will address those later with Paul. And then if you can just keep yourself on mute throughout so that it avoids distractions as well, that will be great. But otherwise, yeah, enjoy and let us know if there's anything throughout. Thanks, Paul.
Great, thanks, Jess, and thanks everyone for joining. I know you guys, it's obviously a busy time towards the end of the year, but we've got, I think, quite a lot of interesting things to show you today. Quite a lot's been happening in the global economy, literally in the last 48 hours. Quite a lot to talk about. So yeah, we'll go through all that. So it'll be we'll try and keep it to about 45-50 minutes, and then have time for questions. But basically, we'll talk about what's happening in the world, what's happening in the economy, specifically around inflation and interest rates. Then we'll go into sort of where the market is. So how's the market pricing this dynamic? What are valuations looking like where are the different asset classes sitting? And then where we see the opportunities in the market, where we think there's outsized opportunities and they're going forward. We're actually quite bullish in general. So you'll get a sense of that throughout this presentation. We're actually feeling like we're actually in quite a sweet spot at the moment, and the numbers seem to be sort of backing that thesis up. So we'll talk about that, and then we'll just cover a couple of our funds. We won't cover all of them. It's a lot to go through. I know the ladies are obviously in touch with all of you, but we'll just cover a couple of the funds where we've made some changes and how things are looking there. Specifically, we'll look at our income fund as well. We've done quite a lot of work on the income fund over the last couple of weeks, so we'll talk about that. Got some interesting stuff to show you there. So we kick right into it, guys. Let's get straight into sort of what everyone's minds is still currently inflation. So I've got a lot of US data, but you can apply this to Europe. You can apply this to the UK as well, where inflation's sitting. So you obviously saw this is US. So you got headline and core inflation. This is obviously after all the stimuluses. We had big runaway inflation. It was very high, and you can see how it's come down. Headline inflation is always a lot more up and down. It's a lot more volatile than core because headline includes both food and energy as well. And those are generally a lot more volatile. So you see it swings around a lot more. But you can see as of actually yesterday, so this is updated as of yesterday, the latest numbers that came out of the US, very positive. So you see overall inflation sitting down at 3.2 and core inflation, excluding food and energy, continuing to sort of steadily drop down, sitting at 4%. Now, if you look at the Fed's target sitting at 2, so it's still quite, if you say, okay, well, my target's 2 and headline sitting at 3.2%, you're still quite significantly above your target. But if you look at the market, anyone who's been watching the markets, both last night overseas, this morning here, and even at the end of day locally yesterday, big bounce in the markets. The markets really saw this information as very positive. And you go, well, okay, but inflation's still quite above 2%. So there's two things. Obviously, the one is it's dropping quite consistently. But if we break down the inflation number, so let's actually delve into the inflation number and see what's causing this inflation still. So definitely come off, it was sitting at over 9. It's all the way down to 3.2 now. So definitely on a nice downward trend. You can see there was a bit of sort of worry in the markets when you saw this little uptick here, but that's definitely rolled over as well. So let's delve into the actual number and look at what the breakdown is. So if we look at headline inflation, these are the breakdowns. So these are the weighted contributions to that inflation number. So if you say overall inflation sitting at 3.2%, so energy is actually deflationary at the moment. Food slightly inflationary, but not much. Medical care is actually on the way down. Commodities have actually been flat. These are year-on-year numbers. The big contributors to inflation at the moment, and the biggest contributor to inflation is a thing called owner's equivalent rent. Okay, it's a very strange line item this because what it actually shows, it's not a real inflation number. So what they do is you've got your actual rent. So this rent's a primary residence. This would be actual rents increases that have gone through the year. So that's a real number. What this owner's equivalent rent is they actually phone up people and they say, look, you own a house. If you had to rent your house now, what would you rent it out for? So it's a theoretical number. And obviously that's very much built on the back of what like property prices are doing. So if property prices are going up, you're going to have a bigger number there. But you can see as the overall contribution to inflation, if you take rent and you take owner's equivalent rent, you're sitting at about 2.5% of the inflation number. It's quite a big thing. That together, in terms of the inflation basket, is about a third. So if you take the weighting of the basket, like how much is residence in that, it's about both real rentals and owner's equivalent rent. You're sitting at about a third of the total basket. And these are both sitting as actual numbers now, about 7% on the inflation number. So if you take 7%, the actual owner's equivalent rent is the higher weighting of the two. It's about 26% of the basket. This is only about 7%. But you can see, so 26% of the roughly 7% increase, that's where you get that 2% number from. So if you just had to half this, okay, and we'll talk about why we think these numbers will actually come down. But let's say you just had to half these, and you say, well, 2.5%, and you half that, that's 1.25%. So you lop 1.25% straight off your inflation number, and you're sitting at the 2% target, okay? So this is why it's quite a positive outcome, even though inflation is still slightly elevated. If we just look at the core and we strip out the food and the energy, you can see that obviously because you stripped out the food and the energy, that the percentage contribution of those two line items becomes bigger. Now you're sitting at over 3% contribution. You half that, you're at 1.5%, 1.6%. You take that off the 4% on the core, and you're sitting it in the twos, in the low twos, low to mid twos in terms of core inflation. So the whole game changes, the whole dynamic changes. So that's quite interesting. So the US has quite an interesting way of adding this like owner's equivalent rent into the inflation basket, but it's really a lagging indicator. It actually follows inflation rate. So when the rest of the inflation comes down, that still stays elevated and only comes down afterwards. And the reason being is if you look at home prices, so this is US home prices, you can see that house prices after COVID had a massive run. So this is your growth increase year on year. You're sitting at, it was consistently at about 20% year on year growth for a couple of months. But you can see lately that's come all the way back down. It actually went slightly negative, but now you're sitting at about a normalized growth again. So you're sitting at a sort of mean growth of about 2.2%, So what will happen is those owners, as we roll through this now, and they phone these people up and they say, okay, well, what are you willing to rent? What would you rent your house out for now? You can see that number that people give, that answer that they give on the phone is going to start dropping. And it's going to start dropping in line with what property is doing. So property is leading this. Property is the leading indicator, and that owner's equivalent rent is a lagging indicator. So although inflation's still coming down nicely, although it's still at 3.2, this owner's equivalent rent situation is going to start to normalize, and that's going to come down, and that's going to break the back of inflation quite severely. You can see, just to show you, this was property before. This was obviously the GFC, so that was a bit of a property boom, bubble and a bust. But now you can see we've normalized back to we haven't really been in a property boom now. It's just really COVID related. Everything went up because of stimulus, but you can see that growth's come back down. So that's the one. If we look at the rest of the inflation, so where is the rest of the inflation? And you look at the actual numbers on the breakdown, there's a little bit in transportation, but if you look everywhere else, pretty normalized. Food, a bit of a contributor, but nothing severe. So if we look at those breakdowns and we say, okay, well, what's happening with the labor? Because obviously this, the US specifically, it's very, a lot of its market is consumer driven. About 80% of its GDP is actually consumer driven. So it's like just spending, it's shopping, basically. You say, okay, well, what is labor? So there was this worry about, if you had this big labor like demand, but you didn't have the supply, you're going to push up wages. Okay. And that did happen, but you can see that that's come off. So if you see the difference between labor demand, which is the blue line, and labor supply, this was obviously COVID. So, the US they turned off the economy, they switched it off. You can see the demand for labor, the demand for employing people fell off a cliff. You can also see the supply came off a little bit. Now, the reason you see supply coming off, you say, well, there's still the same amount of people. The reason is supply comes off is because people actually leave the job market. So this labor supply is actually people who are actively involved in the job market. So it wouldn't include people like, stay-at-home mom, for example, or a student who's a full-time student. It's people actively looking for a job. Okay. So you can see, obviously, then you had COVID, then you had the massive stimulus that came out. And then you had people entering the job market again. So you had labor supply ticking back up, but you had it going back to sort of where it was pre-COVID. But you can see this labor demand just shot the lights out. Massive demand in labor because now you've got all this. You've had all the stimulus in the economy, and people are wanting to employ. And now and that was the problem. So you had all this labor. You had the supply still at long-run normal levels. So obviously, if you've got the demand outweighing the supply, you've got a big upside pressure on wages because you're wanting, so people, essentially the wage growth is going up, When wage growth goes up, what happens to inflation? Inflation goes up as well because people have more money to spend, right? But if you look at what's been happening over the last few months, that's actually inverted again. And that's so if you look at the two numbers, they're kind of at long run trend levels again. But you can actually see labor supply has now taken over labor demand again, and that's very deflationary. So we think, if you take all the other parts of the inflation basket and say, well, what's going to happen to them? They're very much driven by spending, and we think that wages are going to be under control. If we then add into that, savings, so household savings, because that was another big driver of the inflation. You had these two COVID relief packages. So this blue line is the personal savings rate growth in the US. You see it as sort of a long run trend. Then you had these big spikes. So you had the first COVID relief package and the second COVID relief package. And you can see what that did to GDP growth. So obviously we had a drop off in GDP because we turned the economy off, but then you had a big recovery, and that recovery was generated because of these savings here. Then that sort of petered out, and then the government threw in another injection. So there were two fiscal stimulus packages, threw another injection, and then you can see the lag effect of that as well, although a lot more muted. Obviously this had base effects as well attached to it. This growth, didn't have the base effects. You're coming off fairly decent numbers. But you can see how that savings, you can see there's a lag effect to that GDP growth coming through. But if you look, household savings have actually been pretty much at trend or even below trend since like the beginning of 2022. So those savings are vastly out of the system now. So you've got a combination of savings out of the system. You've got labor demand actually being lower than labor supply now. So that's going to put upside pressure on wages. And then you've also got this owner's equivalent rent that is a lagging indicator on the actual inflation number, and that'll come through. As properties come off, you'll see that bringing inflation down as well, even further than it already has come down. So you say, okay, well, is this a good thing or a bad thing? What it basically is telling you is that this act of raising rates has worked. Okay, so what the Fed was aiming to do has worked. Now the question is, well, okay, household savings are quite low, what is that going to mean for the economy going forward? Is this a good thing or a bad thing for the economy? Okay, so let's first look at where rates have been. Okay, so this is obviously the rates coming up. How did this happen? So if we look at the trajectory of those rates, so if we look at the US, this is the last rate rising cycle. So we came from really all-time lows, January 2022. And, the US Fed started to raise. They realized they were raising too slowly, and then they just clapped the economy with 75 basis point hikes, 4 in a row, bang, 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 and then started coming down again. But you can definitely see there's been a tapering off. And if you look at the last 4 meetings, so this meeting in July, they didn't raise. Then they raised 25 basis points. Then they've had 2 meetings. Actually, yeah, there's 2 meetings here where they haven't raised. So in the last 4 meetings, they've only raised 25 basis points. So it looks as though, and if you look at what the sort of word coming out of the Fed, it's a lot more dovish, meaning that it kind of realizes that I think it's done its job, and we'll probably, if we're not at the high of the cycle, I think we are very close. And you can see we haven't had raises. So in terms of now, the question becomes, well, how long do rate raises stay elevated? Or how long do these rates stay elevated, and can that cause a recession? Now, if we look currently at the market, bearing in mind that household savings fell off beginning of 2022. So if we look and say, well, is this a household savings phenomenon, And if we say, well, if we're worried about household savings coming off, will that not affect the economy, considering that the economy is a spending economy? Well, household savings have been off for almost 2 years now. I mean, since the beginning of 2022, we're almost in 2023, and you can see that the savings rate, that blue line, has been fairly low throughout that period already. So it's not a new phenomenon. And if we look throughout that period, what's been happening with the US economy, and you can see it's actually been very robust and very strong. So if you look, this is the US GDP. It's a bit noisy because it's quarter on quarter numbers. But if you just look at it, US GDP has actually been lately actually higher than what's been expected. So the economy has actually been slightly stronger than what's been expected. If you look at US unemployment, that's ticked up slightly lately. Okay, it's still very low. It's come off, substantially since COVID. It's still at very, very, very low numbers, but has ticked slightly above expectations. But if you combine that with the US participation rate, that's also above expectations. And you look at, so the US participation rate is how many people, if you have 100 people, adults, how many of them are looking for work? So how many of them are actually in the job market? Okay, that's sitting at about 63%. So 63% of working age people in America are actually in the job market. So, what's that other 30-odd%? Who is that? That would be 38%. That would be stay-at-home mom, people that aren't looking for jobs. So stay-at-home moms, retired people, students, that kind of thing. They're not going to form part of that. So if you look, so the participation rate's actually gone up. So there's more people in the job market. And then if you say, okay, well, the unemployment rate's ticked up slightly. If you actually take total jobs, it's about where it should be, because the unemployment rate's just slightly higher because you've got more people that have entered the market. And people obviously entering the market's a positive thing, because that means that people are confident about their prospects in the job market. They haven't left the job market. What you can see that this has slowly been raising over time as well, because, after COVID, people that actually, that you saw that, the great resignation and all that, people not actually wanting to be in the job market, wanting to go and retire in a forest somewhere and, I don't know, live on mushrooms or something. But yeah, so you can see people are coming back. That's good. And then if you look at non-farm payrolls, which is the amount of new jobs being added to the economy monthly on a monthly basis, that's actually been substantially above what's been expected. So still a very robust economy. So although you've got savings come off and you've got wage growth being tapped, or the pressure on wage growth being tapped off, the actual size of the economy and the robustness of the economy is still there. So you haven't got this big pressure on wage increases, but you've got more people working than what was expected. That makes sense. So you still got a very robust economy. So all in all, what's basically, to put this in a nutshell, if you look at the US, what the Fed's doing has worked up till now. The question is, do they keep rates at a higher rate, which we'll talk about just now? But really what it's done up till this point has been very good. And, people were expecting this recession that hasn't come. And I think the big reason the recession hasn't come is because it's an unprecedented event. We first paid people money and then raised rates. Usually when you have a rate raising cycle, you just raise rates. Okay, people might actually, if you take the GFC, people were actually quite indebted. They didn't have a lot of savings. So when you raise the rates, you had quite a big impact on it. Whereas now, you've given people cash. You can see the savings rates were massive. And that's been able to kind of sort of almost temper this rate rising cycle. And we think that, so we're actually pretty bullish over the state of the economy. If you just look at some numbers from Europe and the UK, so Europe's inflation is actually below the US's. It's at about 2.9 at the moment. The reason it's lower is they don't have that owner's equivalent rent kind of equivalence. They actually don't have that in the inflation numbers. And so they have a much more complicated way of running inflation, because they've got to look at different countries and kind of aggregate them together. And all the different countries have their own way of calculating inflation. But anyway, if you look at the composite, it's sitting at about 2.9. If you look at UK, so UK numbers actually came out this morning. Don't know if any of you saw, but UK is still elevated inflation. It's at about 4.6. But the previous print was at 6.8. So it's come off a hell of a long way since the previous print, or it's a 2% from then. So actually the market, if you look this morning, has reacted very positively to those inflation numbers too. So we really, where we think we are is, we at the moment do not foresee this potential, recession that the market has kind of been expecting for a long time. We think that inflation's under control. These central banks have actually become a lot more dovish in terms of their rhetoric. So we actually think long-term, from an economic point of view, we're actually in quite a good place. So, what does that mean for markets, and how the market's pricing this in? So forget about what we think, what's the market think? So if we first look at treasury yields in the US, so the blue line is short-term treasury futures. So that is, what does the market think the short-term rates, so the Fed rates? Because remember, the central banks control the short end of the curve. The long end of the curve is controlled by market forces. Okay, so central banks, when they raise and lower rates, are lowering the short end of the curve. Okay, so you can see markets have been pricing in elevated inflation for quite a while on the short end. Okay, you can see, so we're sitting at about 5.25 to 5.5 on the short end at the moment. The markets are kind of forecasting futures to be around that level for a while still. If we look at the US 10-year, so what was previously happening on the longer end of the rate was the market was saying, well, on the longer end, we actually don't think, we actually think rates should be lower longer term. And over the last little while, you've seen this before the sort of November rally, let's call it. You look at September and October, you actually saw quite a big sell-off in equities, not a massive sell-off, but you saw a sell-off in equities and bonds. And part of that was in these long-term bonds. You saw the market saying, okay, well, hell, maybe inflation's not going to come down as quickly as what we were previously thinking. And you saw those rates just re-rate upwards. So you can see now you've got the 10-year sitting at close to 5% as well as of end of October, close to 5% as well with the short-term rates. And we think this has provided a massive opportunity in the yield curve offshore, because we think you're now getting very decent yields. You're getting very, very nice yields, and we'll talk about it a little bit later on that market. Now, what you've seen subsequent to this is you've actually seen quite a big sell-off here. Not so much in the short term, because the Fed hasn't changed rates there, but you've seen the sell-off just literally in the last 48 hours with these new inflation numbers, that this has started to re-rate. And now the market's saying, well, hell, maybe we went too far sort of hawkish, and we need to actually be a little bit more dovish. Maybe, we initially thought inflation was going to be, we thought inflation was going to be stickier than it is, and now we think, well, maybe it's over. So this is providing a really good buying opportunity in the offshore US Treasury market at the moment. So if you look, where does the market think rates will start to come down to at the moment? So if you look at futures and you just look at forward rate agreements and things like that of what a futures market's pricing, they're actually pricing that we'll stay at elevated rates now until sort of mid next year. And they're actually pricing over in 2024 that you're going to have 325 basis point cuts. So they're saying we're at the top of the curve, and you're going to see these three sort of 25 basis points cuts. So you're going to see a 75 basis point cut over the back end of 2024, which we think is fairly reasonable considering where things are now. We actually think where the potential upside surprises is that you start to see rates come down before July 2024. Because if you do get any sort of short-term, let's say poorer numbers in the economic numbers coming out, the Fed has a big runway with which to reduce rates now. They've got a lot of fat in this, rates are quite high at the moment. So, they're at multi-decade highs. So if you look at that and you say, okay, well, can the Fed do something about it? Yes, they can. So they've been able to normalize monetary policy, because there was a big problem when you're sitting at a 0% short-term rate. Where do you go to from there if you've got a problem in the economy? Now they're sitting at north of 5%. So they've got quite a lot of room to think. So that could be a big upside. If you did see that happening, it could actually be quite a big upside surprise in the treasury markets. But even if rates stay flat for the next 8 months, 9 months, that's still vastly actually priced in for where we are at the moment. So we think the potential, let's call risk, is actually on the upside. If we look at so how does this affect equities and things like that? So if we look at the US, we just take the S&P 500, just basically from purely a PE point of view, you can see that it's actually slightly below its mean. So US equities are not expensive by any stretch of the imagination. They're not vastly cheap, but they're actually over, since the early 90s at just slightly below its mean value. So you can see this sort of big PEs. That was the dot-com bubble. This was COVID, so we've actually lobbed that off. It's just what happened here was because earnings disappeared during the GFC. Sorry, this was not COVID, the GFC. Because earnings disappeared over the GFC, you saw sort of big increase, and then as earnings came back, that sort of normalized. And then this was COVID, same thing. But if you see like where we are in terms of valuations, not actually that bad. And what we actually do is we say, okay, well, we're not cheap, we're not expensive, we're kind of fairly priced, but what's actually happening in earnings? So what we do is we have an earnings dashboard that we look at, and we update this continuously. So we're updating this earnings dashboard now. We're actually going through an earnings cycle at the moment in the US. And what this looks like this chart on the left is the S&P 500 earnings, and the chart on the right is the NASDAQ 100 earnings. And we say, okay, well, what's actually happening out there? So if you look, there's actually about 502 stocks in the S&P 500 at the moment. As of yesterday, 460 of them had published their latest earnings numbers, okay, through this earnings cycle. So we've still got about 40 companies to go. You can see all these big ones. These are the big market cap stocks, your Apples, your Amazons, things like that. They say, well, of those stocks, how many actually beat estimates? So how many beat earnings estimates? And about 380 of those companies out of the 460 that have already reported, 83% of them have actually beaten earnings estimates. And if you translate that into an estimated earnings, so this is just analyst consensus earnings over the short term, they say what earnings have actually come through, it's about 7% ahead of where analysts were expecting earnings. So you're still seeing and that ties into what I was talking about with the economy earlier. As you're seeing this sort of upside surprise the whole time, things are just better than there's a lot of bearishness still. And you want to be in the market, you want to be buying in the market when there's bearishness, because that's when you get that upside. That's when you get that potential for outsized return. So you see now, if you take this median return here, this mean, this mean of 25.7, you say, well, we're sitting at 23.6. Well, earnings through this cycle are actually 7% higher than what was expected. So you can already take 7% off that number without moving the markets at all. So you can see we're starting to get a re-rating just by earnings coming through at an accelerated rate. If we look at the NASDAQ, very similar thing. So the NASDAQ 100, you get the NASDAQ composite and the NASDAQ 100. The NASDAQ 100 is just the biggest 100 on the NASDAQ. 81 of them so far have reported. 73 have beat estimates. So 90% of them have actually beat earnings estimates. And it's also about 7% ahead in terms of if you had to aggregate all those earnings. So earnings still looking like really healthy and a lot far ahead of what is being priced in or expected to be priced in. So that's quite encouraging for us. We just look at other global markets here. I mean, you can look, okay, so that would be the US. The US generally trades at quite a premium. It can trade at quite a premium over time. There's a lot more growth in the US. So like, all the innovation, all the tech generally happens in the US. So it's very rare that you'll see the US trading like below these other markets. If you look at emerging markets looking really cheap, kind of like South Africa, which we'll talk about just now. If you look at Europe, the East, you're also kind of looking at quite cheap. And then if you look at like all countries, which is like, basically developed and emerging markets together, so the biggest bourse you can look at. And we're sitting at about a forward P of about 15 at the moment. So you can see based on historical numbers, not crazy expensive, not crazy cheap, but not crazy expensive either. So fairly valued. But like we say, if you start seeing these earning surprises, that's actually quite encouraging to see on a fairly valued market. When you see earning surprises, that's actually a good thing. If you look at some of the themes we own, so specifically, we still like the US. So we've been quite bullish on the US for a while now. We still like the US a lot. It's our favorite if we're going to go develop markets. We've got a big chunk that's kind of tilted to the US on our offshore allocations. We just prefer it to Europe and the UK. We think the UK has obviously got its issue, quite severe economic issues at the moment. And Europe, just demographically, we don't like Europe. It's got no growth. So, I think the projected numbers for Europe over the next GDP growth over the next reporting period is like 0.1% up. So we're not too excited about that. Whereas if you look at the US still, US is sitting at, north of 2 in terms of economic growth still. It's still got good demographics. It's still the innovation hub of the world, and we like it. So we specifically like the US. And then what we do is, obviously in some of our funds, we look at thematic opportunities, and just thought I'd talk a bit about how we think about those thematic opportunities. So what we do here, if you look here, so when you're looking at thematics, on the x-axis would be interest in a theme. And on the right axis, or on the y-axis would be innovation in that thing. So if you look at like, solar and wind, like wind turbines and solar power, not very exciting. You've got a lot of market interest in that already, and you don't actually have much innovation in that. So really, what you want to be doing is you want to be buying either stuff on the left of this that you think could create interest, so that there could be interest in it. If that interest increases going forward, that you're riding that increased interest, or you want stuff that's high on the y-axis because it's got a lot of innovation in it. So obviously any industry that's got high levels of innovation is generally quite profitable, because what that innovation tends to do is it either opens up new revenue opportunities or it decreases the cost on those businesses and allows them to create outsized margins, or a combination of those two things. So if you take like tech, US tech as a general idea, you can say it's quite deflationary. So, the fact that we're able to have a meeting on Zoom at the moment, that brings down the cost of running a webinar, for example, and they make money off doing that. For example, so you can ride that theme. So some of our themes at the moment, we hold quite a good size of in our thematic offshore exposure of nuclear energy. Okay, and the reason and really what we're looking to there is I think, after the energy crisis in Europe over the last couple of years, when they realized that they had over relied on Russia, they're starting to roll back a lot of this sort of very naive, just looking at solar and wind to power everything. You're never going to like run an aluminium smelter on solar panels, for example. It's just not going to happen. So I think they've realized they're looking more at natural gas again. So they're actually looking quite heavily into natural gas, but also bringing the nuclear fleets back. So if you look at like Germany, for example, Germany cut down all its nuclear fleet. It's actually starting to re-implement some of those. France is quite clever. France, about 80% of France's power actually comes from nuclear already, and they've kept it that way. So if you look at like France's energy versus Germany's energy situation, very different. So we think Germany will follow suit. If you look at like the US, if you look at big projects granted in the US, for example, starting to favor nuclear. Nuclear has been out of favor in the US since the 3 Mile Island disaster. But now you're starting to see that coming up. And actually, it's been a great holding for us. It's actually our best holding on the offshore side. It's even better than semiconductors, which has done really well. And the reason is we think that interest, so you can see there's no interest in it, but we think over time, as you're getting this push for renewable energy, but you're getting more pragmatism around how you do it, nuclear is the obvious way to go there. And there's quite a lot of innovation. It's quite a significant amount of innovation in the nuclear space. You've got these like third generation sort of modular reactors now that are a lot safer, and they're much more easier to implement. They're much more easier to commission, very efficient. So we think that's a good space. So really the call there is it's a fairly highly innovative technology, but we think that the interest, when that interest pulls through, you're going to see massive. We've already seen about a 40-50% return in these things of very depressed levels, but they're still very cheap. So we like that. If you look at US tech, we like US tech. It's it's an ongoing. We still think that like we own obviously our US tech through the NASDAQ as a composite. We still think that just generally over time, that growth theme that you get through tech, that innovation is going to come through nicely for US tech. And then we do have quite a chunk in semiconductors as well, which has also done very well with us, but we think going forward will continue to do well. It's looking more expensive at the moment, but when we go in and look at the valuations, so what we've done here is let's just look at sort of tech in general, NASDAQ, all in all. What we're saying, so if you look at NASDAQ now and you say, okay, well, how does it compare against like MSCI World, for example, or the S&P 500? So our sort of forecasted return, these are all in US dollars. If you look return estimates on MSCI World and S&P 500, very similar actually. We think a sort of 5-year return from here of about 11% in US dollars, which we think is quite good, just based on our assumptions. If we look at NASDAQ, so NASDAQ's actually more expensive. But what happens with these things, it's like people have been calling like NASDAQ to come off for years. It was just always expensive. But what people don't account for is that the long-term growth, that increase in earnings every year, that compounded effect actually more than outweighs the current static price increase. So for example, if you buy a company that has a 10% growth rate over 10 years, and you buy a company that has a 20% growth rate over 10 years for twice the price, you're going to do way better out of that company because that compounded effect of the double earnings growth going forward is actually way more than double. It's actually a hell of a lot more than double. We're talking, 5-6 times more. So even if you buy the twice the price over a 10-year period, you're actually going to do a lot better because your earnings comes through at such a high rate. And that's what I think the market the market looks generally a lot more short term. They look kind of 2 years. That would be a long holding for even a fund manager these days. It's like 2 years, it's a long holding. So they're not thinking about these long-term compounded earnings effects that are coming out. So when we look at the NASDAQ and we say, well, what, let's say 5 years out, NASDAQ had no extra growth priced into it. So let's say in 5 years, it priced exactly at what the S&P 500's long-term price to earnings is. So it doesn't price. So historically, it actually does trade at a premium because it's got more growth. But let's just say that all disappeared. And 5 years from now, you say, okay, well, from where it is now, let's just say 5 years from now, it's going to trade at what the S&P 500 has been trading at on average over the last long-term time horizons. So you're not pricing in anything exciting. So say you're getting a price re-rating there because it's actually at a premium now. So you're saying, well, actually over 5 years, then you're going to lose on the re-rating of the price. But when you factor in those expected growth numbers coming through, which we actually think are probably underdone, because generally what happens in the technology space is earnings always surprise on the upside. Okay. And you factor that in and you add, so that would be the blue. So the light blue is the return you're getting from the earnings growth. The dark blue would be the loss you're making from that re-rating in terms of, let's say, like all the positive news from NASDAQ just disappears and it's just treated like any average S&P 500 stock. you would actually be sitting still at a projected 5-year return of about 12.6%. So still significantly higher than what we would get out of normal global stocks and even the US. So you can see that net effect. So you're getting a little bit of a loss on the re-rating, but you're getting a massive gain on the earnings income. And that net gain is still very positive. If we look at semiconductors, so the same thing. Semiconductors, you would lose a little bit on the re-weighting, on the valuations, but you're going to gain a hell of a lot on the earnings growth coming through. And we're really excited about semiconductors. We do think that there's a big sort of blue sky in the semiconductor space. There's been quite a lot of hype around the AI, but we just think, I mean, if you just look through, you look at e-vehicles, for example, you need semiconductor growth. You look at smart technology. So you look at like smart devices, for example, semiconductor growth in computing. The demand for semiconductors is just, I think, still in a very sweet spot. So our rates, if you look at sort of market consensus of where those growth rates are going to be, and you look at our numbers, we're expecting quite an outsized return on semiconductors, even though at the moment they're a little bit more expensive than the rest of the market. Okay, and then if you look at uranium and nuclear, similar kind of story here. So this is actually opposite. The shares, even though they've run up about 40-50% since we've held them, they're actually a lot cheaper than the market. So if you just got a re-rating, so we talk about this interest. So if this interest just had to normalize, you just see it more in the sort of in the public domain. You see it more. You're already starting to see that picking up politically. Like I've said, a lot of nuclear projects online. You would see a increase in the valuation, and you would see an increase in the earnings. So we're still expecting sort of market-beating returns on these themes. So we're quite excited about these themes. They've done well for us since we bought them, but we're going to hold on to them. And we think long-term, they're still very good themes. And the way we manage money in these portfolios is they're really sort of satellite portfolios. So we've still got our big market cap weighted holdings, and then these are sort of alpha generators that are on the side. We hold limited amounts of them so we can limit the tracking error and things like that. But yeah, quite positive on our themes at the moment. And, we like the US, we like that innovation space. We still think long run innovation is actually going to, I think, generate more of a premium, because as you get demographics globally sort of, China's just recently gone into negative population growth. Europe's about to go that way. Japan's been there for years. The only place where you still got positive demographics is in the US, funnily enough. I'm talking about large economies that are worth talking about. So we think actually that growth premium actually there might be more demand for growth or less supply, let's say, for growth going forward. We actually think that premium actually increases rather than decreases just because of global demographic trends. People are going to be looking more for growth because there's a lot of deflationary demographics in the world, just these secular trends long term. If we look at offshore yields, also an opportunity we think in offshore yields. We'll talk about local yields just now on the bond side. But if you just look offshore now, so offshore US treasuries, and we specifically like the treasury space, they're yielding through the curve now at about 4.7% in US dollars. So that's 4.7% in hard currency, okay? If we just go and play a scenario analysis where we say, okay, well, let's say we're wrong about everything. Let's say inflation just jumps out of nowhere. Highly unlikely, but let's say that happens. And the US Fed is forced to raise rates by another 2% over the next year. So this is a 12-month, all these numbers are 1 year looking out. What would the return be in treasury? So you'd actually you'd still get your 4.7% return over the year. That's your yield, but you'd get a massive drop in capital. So you'd be down about 20%, okay, in dollars. But we think in a situation like that, you probably have a lot of rand weakness as well. So your holding would be quite protected. If they go up another 1% from here over the next year, also highly unlikely, you'd see about a 7.7% drop. But the reverse, which we think is a lot more likely, is actually a lot more exciting. And you've got this sort of asymmetry in outcomes because your yield is suddenly a lot higher. And because your yield's higher, your convexity starts to increase as well. So the rate which you change in terms of your rates. But if we look at a 1% down, so remember the market's actually predicting about a 75 basis point drawdown over 2024, 325 basis point drops in yield over 2024. We've just put it in at 1 year, but the 75 are going to be a little bit less. But at a 1% drop in rates over a 12-month period, US yields in dollars are going to do 17% in dollars over a period like that. If you had a 2% drop down, look, this is probably unlikely, but just to show you the potential, you'd get a 30% return in US dollars over that. And you can, and so we think like treasuries. We really like treasuries. We've upweighted them slightly in all our portfolios. We really like the US treasuries because now at least you're getting, before you were getting like 0% in dollars. So really your call was exchange rate. But now you're getting a 4.7% return in dollars. Now, if you couple onto that, we still think long-term the rand will weaken against the dollar, 3-4% added. And rand, for a rand-based investor, it's not a bad outcome. Also considering that you have this potential capital kick as well. If we are at the top of the cycle, you see that start coming down, you got those potential capital kicks, which we're quite excited about too. So that's the kind of global space. If we look locally, what's happening? So locally, if you look at our inflation, kind of ticked up slightly here, but sort of well within 3 to 6 band that we like. You can see we've increased rates quite severely. So if you look at our inflation, we don't need to raise rates. The only reason we still been raising rates is because we need to protect the currency. So obviously, if the globe is raising rates as an emerging market, we kind of hitched our wagon to that. We've got to go up with them. It's just because you want that inflation, you want that yield differential to protect the currency, because you don't want to import inflation if you weaken your currency up. But in and of itself, we don't actually have an inflation problem. We're quite well within the bands. So if you start seeing the developed world, specifically the US, start to raise rates next year, which we think will happen, we will start to reduce rates. My apologies, which we think will happen. We will start to reduce rates as well in line with that. Because inflation for us, like I say, you have this little uptick. It's a bit noisy in the short term, but we really don't see it as being a problem. It's sort of very well within bounds locally. You can see inflation never really actually got that massive throughout the system. It was a lot higher offshore because they had all that fiscal stimulus. Most of our inflation here was imported inflation, really. So again, kind of like with the GFC, we kind of almost sort of victim. We kind of have to dance by everyone else's tune globally, as you can see. So we think our rates will come off with those rates when that happens, but we don't have our own inflation problem at all. If we look at valuation, so the blue line would be bond yields. So this is the All-B yield at the moment. The All-B yield sitting at about 11%. You can see this is over the last 20 or so years. You can see we roughly, we're pretty much at all-time highs. So you can see these things sold off. It sold off during the GFC. It sold off during COVID. This was the whole Nenegate scandal, if you remember that. And you can see it's been fairly high. And the reason it's been high is because offshore yields have been high. But really, you're getting very good valuations here. And we think, if anything, will potentially come down over time. If you look at the red line, that's the earnings yield of the all share. You can see the earnings yield of the all shares looking really attractive. Now, if you look, earnings on bonds should always be higher than earnings on equities. So there should always be a premium on bonds, on earnings premium, because equities earnings grow over time. Whereas if you buy a bond that's yielding 10%, you're going to get your 10% fixed until that bond matures. The earnings don't go up. Whereas, corporate earnings actually increase. So generally you'll find over time, it's very rare where you'll find shares being cheaper than bonds on an earnings yield basis. You only really find it in crises. So you obviously found it during the GFC. That was a big crisis where you found it. But that obviously just proved to be a massive buying opportunity. But generally, you'll find that premium quite wide over time. And you can see that it's shrunk over time. So you can see from an earnings yield point of view, the only time we were cheaper was a very short time during the height of the GFC. But otherwise, local share valuations are looking really good. So you say, okay, well, what's the outcome locally? It's not positive. I'm not saying that the outcome locally, economically, is this positive environment, but at some point valuations matter, and you're getting a 10% earnings yield on offshore on local equities at the moment. Now, if you do start to see the bond yields come down as rates drop, both globally and locally, this premium would automatically have to start coming down as well, because like I say, over a long period of time, that's generally the trend that happens. It's very rare that the market arbitrages those outsized opportunities away. So if you're only yielding, you right now, so the all shares yielding 10, but you can get 11 from bonds. Let's say bonds start only yielding 8. The market's not going to allow for too long the equity market to be yielding more than the bond market, considering equity market returns go up over time. If that makes sense. So both asset classes, both bonds relative to historically bonds are looking really attractive, and equities also relative to history looking very, very attractive from a valuation point of view. If we just put this on another chart, so here you've got the earnings yield at the bottom, and you've got the 5-year subsequent annualized return. So what happened historically? You can see on the bonds, historically you're sitting about here. Historically, your returns were anywhere between sort of 11 and 13% over the next 5 years. It's a really good outcome for bonds. And on equities, historically at an earnings yield of 10, you can see it's very cheap relative to where you see most of your observations. Historically, you've seen like very big equity returns over the next 5 years, anywhere from 19 to 30% annualized over 5 years. We're not as bullish on this because we do think that the economy will suppress it a little bit. So we don't when we run our models, we don't have these as high expected returns. But I mean, if history is anything to go by, at current valuations, those are the returns you should be expecting going forward. If we look at the asymmetry on our bond market, so this is on the left-hand side. On the right-hand side, I've just put in the US Treasuries just for comparison's sake. But if you look at the bonds, so we're talking about currently the yield is 11.6%. So let's say you had no change in interest rates over the next year on local South African bonds. You're going to go and do 11.6%. That's the current yield on offer at the moment. So no change in rates, 11.6%. If you start getting changes in rates, okay, so let's say we roll and we get 2% from here over the next 12 months. Because of the strong convexity of our bond market at the moment, because most of the bonds are trading at quite a big discount to their par values, so you've got to make up that. Remember, if you buy a bond at 100 Rand, you're going to get the 100 Rand back when the thing matures. If you're only buying the bond at 80 Rand, you still get the 100 Rand back when the thing matures. So you're getting this convex thing. So because our bonds are trading at discounts, you will get some loss on the capital. It's not as much, but then when you factor your yield in, you're still going to have a positive. So even if rates here go up by another 2% over the next year, you'll still do like 4% just in the bond market, which is a seriously negative outcome. Okay, so you're not actually losing money even with such a big sell-off. If you get a 1% increase, you're still going to do 7.5% in rands on those bonds. But we think the reverse is much more likely, where you actually get a 1% down over the next year, like I've already mentioned. If we got a 1% down, so 4 meetings of 25 basis points over the next year, you're going to do about 16%. That's equity. That you'd be happy to do that out of equities. And if you got 2% down over the next year, you're going to do about 20% in rands. So you can see there's this asymmetry of returns in the bond market at the moment. And why? It's because the yield is just so high. You're getting that yield. Remember, when you buy, regardless of what happens in the market, you're going to get the yield. So we're always going to get that yield. So we like, so that's why I say we're quite bullish. Actually, all asset classes at the moment are looking very attractive for us. And we actually think, things are looking really good. And if you look at the last 48 hours, what's been happening in the market, you've seen this big sort of surge up, which has been quite nice to see. I think it's been much needed. Obviously, there's been a lot of volatility in the markets over the last year. So that's kind of so we've talked about the economy, we've talked about sort of where we see valuations. If we quickly go through our funds. So the Enhanced Opportunities Fund at the moment, and now remember, this fund feeds into our stable, moderate, and managed funds as well. So these themes that you see here will feed through into those funds as well. You can see we've got our sort of uranium and nuclear, we've got our semiconductors, we've got an emerging market tilt, we've got the tech NASDAQ 100 that we like a lot. We still got a lot, and then the rest is actually an S&P 500. So on the global equity, it's really a gap between, we've got a small amount in emerging markets, but the majority is in the US, even the NASDAQ, predominantly US companies. Semiconductors, it's global, but predominantly US. So there's a big US tilt that we like. Then we've got our local equity at about 40%, local bonds at about 20%, and then sort of red. We've got a bit of an income now. Never used to own offshore income, but we're introducing it. A bit of property, and then our local property as well. If you look at what the fund's done, it's a newer fund, but since inception, obviously I can't show you November's numbers. I've got to show you month end. So I've got to show you end of October, where there was a bit of a sell-off. But you can see, quite far ahead of the benchmark. So the fund's been doing well over the last 8 months since we launched it, and it's been feeding well into the other funds. But if you look at November, like I said, I can't show you the numbers, but if you want to go offline, I can show them to you one-on-one. Been a good bounce here, just since the beginning of November. If we look at our offshore equity carve-out, so that's talking about our themes, our US exposure, our tech exposure, and all that. The offshore equity carve-out's been phenomenal since we launched, so it's up at about 11%. versus sort of if we're benchmarked against ACWI, which is your sort of big offshore benchmark, we're about 6%, 5-6% ahead of benchmark. So that's been really good for us. If we look at our income fund, so we've made quite a lot of changes here. So what we've done, if you look at here, we've actually sold our holding in Sasfin, and we've sold our holding in Stanlib. And we've bought, what we replaced those with is the MyPlan Enhanced Income Fund. That's actually managed by Vunani. It's a white label fund, but a really good fund, really good track record, and Truffle. So the Truffle really being the short-term fund that replaces Stanlib, and MyPlan being the sort of more multi-asset type fund that replaces Sasfin, okay? We did this for a few reasons. We just weren't happy with the performance of those two funds. Also, the funds are quite big, so the potential for opportunity is a lot less. And what that really enabled us to do on the fund is just to look. I'll show you two things. So this was the yield and duration of our fund in May 2022 last year. So you can see with the rates increase, what has happened is that our new yield was sitting up here. So our new yield was sitting at over 11%. So you can see it was just over 8%, coming up to about 11.5% yield on that income fund, okay, without any changes. What we've been able to do by adding Truffle and by adding MyPlan, we've actually been able to bring the duration down, and we've actually been able to bring the yield slightly up. So going forward, this fund is actually going to be quite significantly less volatile than what it has been in the past because its duration's lower, but we haven't sacrificed. If anything, we've actually gained yield on the portfolio in order to do this. It's still a very well-balanced portfolio. So you might say, well, why not just have everything in BCI Income Plus? Because it's got like no duration and a massive yield. The simple reason, credit risk. So it takes more credit risk in the fund. So we still want quality. So we'll still own like Granite down here that doesn't have as high yield, but it's owning a lot more high quality stuff. So we'll be exposing ourselves to a lot more risk by just owning that fund. So we're still a very well diversified fund, owning very, very different types of income funds. But you can see we've actually going forward brought that. So we made these changes about 3 weeks ago. So we've brought that volatility down, but still kept that income up. So you can see that income yield is actually as high as the Orbi yield. So if you just go in and bought sovereign bonds, you're sitting here, but you've got a massive duration. Now that can be positive if you get a decrease in rates, right? So we still like the bonds. We own bonds in our other portfolios because we want that capital kick if rates come down. But yeah, on the income solution, it's a much more conservative solution. You're still getting the yield, but it's going to be a lot less volatile going forward. So you can see that that's how the income fund looks at the moment. So you can see we've introduced the MyPlan fund as well as Truffle. And we've replaced, as I say, Stanlib and Sasfin. Sasfin, funnily enough, so the Portfolio Metrics Fund used to be managed by the guy who was now managed by the old manager of the Sasfin fund. And you can see how those funds have changed. So technically, it's the same mandate, but you can see that we followed the manager, and the manager's getting much better. So he's got a much higher yield, much lower duration. That's what we want from that fund. And you've seen that sort of gap in those returns over time. So we just made the call now, Arno, the new manager of Sasfin, we just made the call. We're gonna move on from that. If you look at our income fund over the last year, quite happy with it. As I said, it's been a little bit more volatile. That volatility will actually come down now as this duration has moved from about 2.15 to about 1.8. You'll see this volatility going down, but we should still be getting the yields. And then if you look at Global Flexible, that's sort of our holdings on Global Flexible at the moment. We have a little bit more real estate, which we really like. I haven't spoken much about real estate today, but we like real estate. It's offering a good yield. And we think if bonds rally, real estate's going to do even better. So, and it had, real estate overnight kicked up about 5%. So we like that. And then also I like our US exposure, our tech exposure. So looking pretty well balanced, pretty happy. We've got quite a significant holding in treasuries. So global income at the moment, we've got high yield. This high yield's giving you about 9% in dollars at the moment. Then we've got the short-term treasuries and the long-term bonds at about 11% compared to 2. So we're getting a nice yield. So on these two, we're getting about a 5% yield in dollars. And this one, we're getting about an 8% yield. So good yields here, decent chunk in income that we really like. And then we've got this, I suppose, could be a combination of an income play and a capital growth play, but about 11% in property with the remaining sitting in equities. And then we've got sort of market cap tracking, but then with some EM, but quite a tilt towards the US again. Now, if you look at how the fund's done since end of October, again, I can't show you November, but since end of October, quite nicely ahead of benchmark, quite happy with the returns. And as I say, it's actually a nice kick since November as well. So that's it from my side, guys. That's the basics. Obviously, our other funds, have also performed very well, stable, modern, and managed. But I know that the sales team and the ladies have been talking to you about those individually as well. So I know those have done well. But I just wanted to sort of cover some of our more building block type funds. But that's it from our side, guys. I don't know if there's any questions, Jess.
Yeah, Paul, there's a few questions in the chat box. Let me start with the first one. Nick asks if there's any views on China. I know you did touch on it, but if you can maybe briefly give your view on China.
Our long-term view on China is not great. We think in the short term they'll be okay. They still have a lot of cash that they can throw at the problem, but China has been relying on debt to grow its economy for the last 20 years. It is highly indebted, and now the problem is it's already been relying on a lot of debt to grow its economy from a position of where it didn't have much. So now the problem now is it's already got a lot of debt. So if it's going to rely on more debt, that's going to become a big problem for it. That's why you're seeing like the China property market's already in a bit of a crisis. Actually, it's because it was just those companies are just overly leveraged and they just can't. I mean, there was actually a number that I was looking at the other day. Apparently, there are enough apartment buildings in China to house double the population. So 50% of the apartment buildings in China are actually vacant. You don't live in them. And that's just been funded by debt from these property companies. But that's happening to an extent with the rest of the economy as well. So you've got more debt. So it's going to be hard for them to fund growth with more debt going forward now because they've already got so much of it. And the other problem is demographically, they're actually going into declining population growth now. So whereas, you've had I suppose part of the sweet spot in China over the last 30 years has been one, the debt, but two has also been the move to this growth in the middle class. Okay. And that was driven by wealth creation as well as birth rates being very strong. Okay. Population growth. You've still got a big potential of the economy of the population that needs to become middle class. So the growth of the middle class can still drive that for a while. That's why we think short term over the next 10 years they'll be okay because you still got a lot of poor people that need to sort of come up. But long term that's limited because population's actually on a decline now. So if you look currently they're at about 1.3 billion. The UN's forecasting their population to be about 800,000 in 2100. It's not a pretty picture for them. They're not having babies. So one is they had the one-child policy. They've unwound it, but that's caused a big sort of hole in the demographic equation. But number two is that people in China, that when you live in a very authoritarian country like that, it's still a communist country, and it seems to be sort of cracking down again. So it liberalized economically, but now it's kind of becoming a lot more. It's kind of cracking down, becoming a lot more authoritarian economically. People they're not positive about the future and they don't have kids. So they're not having babies there. So that will become a problem. So long term on China, we think the US is a much better space. So if you look US versus China, we think it's a no-brainer where you want to be back in the US.
Thanks, Paul. And then there's two questions from Jacques. One of them is looking at the US elections. What is your view on the risks and changes, as there can be significant focus shift from the government? And then maybe that ties into that. What are our views as New Road on value and opportunity locally if you look at the funds?
Yeah, so look, the US election, I mean, that's an unknown at the moment, I think it's going to be much like the last US election. I think there's going to be a lot of noise made about it. Not the last one, sorry, the previous when Trump got elected. If you remember back then, everyone was saying, when Trump gets elected, Trump's never going to get elected. If he does get elected, the markets are crashing. The markets actually rallied. Turns out markets like Republican presidents, believe it or not, which makes sense. But anyway, I think if it's status quo and you get a Democrat president in, I think those are made a lot of hype in the media, but economically and in the markets, they're not really big things. If you look at the US system, it's almost irrelevant who the president is. The president, I mean, they get all the hype and the noise, but I mean, the government, I mean, it's really your Senate and your House, your two houses of Parliament, the Senate and the House of Representatives that govern the country. That's been tilted Republican now since the last midterms. We foresee that being the case going forward. So we don't actually think it's a lot of noise. The elections in developed markets make a lot of news on the media, but actually they've got a lot of checks and balances. It's much more important like a local election here, because there's much more at stake on a local election than there is on a US election. So tying that into locally, we think there's potential upside. Like, I mean, looking at latest polling, so we follow polling quite closely. The ANC at the moment's polling actually came down in the last poll numbers. They're polling at about 45, 46%. Probably on the day they'll come out. We still think our base case is that they come out in the low 50s, so maybe like a 51, 52. But even then, if they come back into power or outright, it's still, you still have the potential for a market shift, because the market's saying, well, they've been severely weakened. You don't need things to happen. You don't need things to change. Remember, the markets are forecasting tools. So if they just see positivity in an outcome, they can still rally ahead of that. So we think actually the potential outcome with South Africa on a positive is higher than on the negatives. I mean, the worst case. Okay, so what's the sort of worst case scenario? ANC gets elected again. They've already been governing us for 30 years. So okay, more status quo. We think the potential is actually on the other side. Where you get it. I mean, can you imagine they go under? So can you imagine they go under 50? I mean, that could be a big kick for the markets. And, we don't think that's fully priced in. There's still a lot of money offshore, for example. We like offshore, don't get me wrong. But you got to limit that exposure, because imagine you get an outcome. It's not our base case, but imagine you get an outcome next year where ANC is at like 40 and EFF's at like 8, and you get a coalition government coming in. You get the moonshot pack coming in out of nowhere, right? The rand goes from 1850 to 1550 in a month. That's a potential risk that we don't think South African investors are actually pricing in, and they should be thinking about that as well. If you get status quo, ANC goes and gets 55, 56%, yeah, I mean, no difference. We've had that for decades now. So, but if you see that weakening, so let's say they go and get 51%, or even if they go under and they go into a coalition with the EFF, which we actually think is unlikely, we can get into the details around why we think that would be unlikely, but let's say that were to happen, the market could still perceive that as a very strong point, because obviously you would have the EFF ANC government over the next 5 years trying to undermine civil society, but our civil society is actually strong. It could hold out for 5 years. The ANC on themselves is quite left-wing. I mean, they come across as sort of, there's a good and a bad ANC. There's no good and bad ANC. There's a left-wing ANC, and they are anti-capitalist, central planning, big government intervention. That's where they want to be. So the rhetoric of having an ANC EFF election in reality is not going to be much difference to just having an ANC government, to be honest. Although they make more noise, granted, the EFF makes more noise. Practically, it's not going to be any different in terms of policy. So yeah, I mean, then you would probably see a holdout for the next 5 years, and then you'd probably see the both of them just collapsing. And that's what the polling and the economic specialists that we speak to, that's kind of what they're seeing could happen in that event. But probably what will happen is you'll probably get an ANC in the low 50s, 51, 52, barring any big changes, and just the status quo for the following 5 years. But you might see the market saying, well, sheesh, man, that means probably 2029 they're going under 50. Quite significantly under 50 probably, and that could be quite positive for markets. So it's hard you never want to bet around an outcome. You always want to hedge your bet. So we've got the offshore exposure. If you do see a bad outcome, we've got a lot of offshore exposure, but our bonds and our equities are good value. You can't ignore the value that's sitting in front of you. So long answer to a short question. There's a lot of ramifications, but ultimately, what can we control? We can focus on what we're buying. And what we're buying is good value. So, yeah. I hope that helps.
Thanks, Paul. I don't see any other questions in the chat. So from our side, thanks so much for everyone's time. For those of you who missed it in the beginning, we will be applying for CPD points, but just give us a few weeks for that to come through. It will be emailed to you from us. So give us a few weeks, but other than that, thanks so much for your time, and thank you, Paul. It was a lot of valuable insights.
Cool, guys. I hope that added some value to you guys, and always happy to be in touch on a personal level as well. If any of you have any further questions, reach out to us. We can have a lunch, talk about things in more detail. But thanks, guys, and all the best for the end of the year. I hope it goes well.
Paul, it was excellent, man. Fantastic. Would be nice to be in touch with you.
Perfect, guy. We'll set that up.
Thanks, buddy. Bye.
Ciao. Bye.